there are 5 elements of accounting, and it's critical that you know the definitions of each of them. You might even call it elemental. G'day there guys, my name's Philip Wong. Now of course there are 5 elements of accounting, and they are assets, liabilities, equity, income, and of course expenses. There are 2 stocks and 2 flows, and one of them is a residual or balancing item. So today we're going to dig into the technical definitions of each of these elements. And yeah, I know that these sound really boring, but it turns out that if you start thinking about these, there are actually quite a lot of instances where things don't quite fit into the definitions, and that's where things can get really interesting. Now, I'm not really one for rote memorization, but it is important that you know these definitions by heart. And let's face it, it's pretty easy, and I'm going to show you how. Now, for each of the elements, the definition is actually split into 2 parts. First off, there is the definition itself, and there's this additional item called the recognition criteria. We're going to start off with assets. So let's say that you're looking at a thing and you're not quite sure whether you can count this as an asset or not. Let's say that you work for a local doctor's clinic, and at the back of the storeroom you find yourself a bunch of old trade journals, magazines and books. All of these books seem to be about at least a decade old, and you want to know whether you should be able to count them as an asset on the balance sheet or not. To find out, you need to look at the definition of an asset, which is found in paragraph 49A of the conceptual framework. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So let's break this down. 1. Controlled by the entity. 2. Result of past events. 3. Future economic benefits. So for anything to be an asset, it must actually pass all of the criteria. Failing on any one point will lead to derecognition, which is accountants' way of saying we're simply not going to count it. So let's look at a few things here. First off, control. This is not the same as legal ownership. It's usually taken to mean you have the right to sell the asset or do what you will with it. Sometimes you can have something, but it's not legally yours, but economically it might as well be. Say for example, you're an art dealer and the client gives you a painting to sell on an agency arrangement. Legally, you don't own the painting, but it's your job to sell the artwork. You give the funds to your client, minus of course some dealership fee. Here, ownership is not quite the same thing as control. Past events isn't the same thing as a transaction or as if you had bought it. Take for example, if you work in a gold mine and you discover that there are in fact diamonds in that mine as well. Suddenly your mine is worth a lot more. But it's not like you bought the diamonds separately of the mine. You just happened to find the diamonds while you were there. They're legally yours and you get to keep them. Now, the act of discovering the existence of these diamonds is considered to be an accounting event, but quite clearly it's not a transaction. Finally, the existence of future economic benefits are taken to mean that this thing, this asset, will help you make money somehow into the future. If it's a block of land, maybe you can rent it out. If it's a bar of gold, you can sell it for cash in the future. It could be even something that might help you save money in the future or simply avoid costs. Take for example a fire extinguisher. Sure, you're not going to make any money off having a fire extinguisher, but it will save you from burning your house down. So let's go back to the stack of old books and magazines at the back of the doctor's clinic. We definitely have control since they are, after all, our books. They have resulted from past events since we must have bought them or someone gave them to us. Maybe a friendly pharmaceutical representative. But the question is, do they recommend a clear future economic benefit? This part not so much. You see, for doctors, medical practices are changing all the time, and the information in these books can go out of date pretty quickly. Books that are over 10 years old may contain some misleading information, so you can't really sell them, can't really use them, and you probably couldn't even give them away to medical students because they're out of date. So we say therefore that these books have essentially no future economic benefits, and thus they will fail the definition of being assets. We have a thing, but we don't have an asset that we can write down on our balance sheet. Next, we're going to review the recognition criteria. And again, if our thing fails at this point, then we won't be able to count it. For an asset, it must be probable that we're actually going to receive that future economic benefit and that it can be reliably measured. Probable just means that there is a greater than 50% chance that the firm will actually receive the benefit. So gold bars meet this definition, because somebody out there will definitely in future be willing to buy those gold bars. But if you were to buy a lotto ticket for this Sunday's big jackpot draw, well, we wouldn't bother counting it. You see, there's an absolute minute chance that you're actually going to win that jackpot. And let's face it, there's not even a greater than 50% probability that you'll even make your money back. Reliability means that you're going to do the same thing again and you'll get roughly the same answer. But notice here that this does not mean the same thing as being accurate. Now, if you actually read the accounting standards, nowhere do you find the word accurate. This is kind of funny because most people stereotypically think of accountants as being exacting and accurate people. But it turns out that when you're trying to find the true value of something, sometimes accuracy is pretty much impossible. Say, for example, you have to value the land on which your business sits. You look at the recent nearby sales and consider the features of that land before deciding that the land is worth a little over $2 million. But how do you know if it's really worth $2 million? Well, the only way that you could be really sure that it was worth $2 million would be to sell the land. But then you don't have the land anymore and you can't use it for your business. But if you were to get an independent land valuation from a surveyor, you make a judgment and also the auditor checks off on that valuation, then that's these three sets of people, all of which more or less concur. And this means that it's much less likely that any one person there has been wildly inaccurate or even terribly biased. Again, it's reliable, but accurate? Harder to say. Okay, so that was a lot of work and we've only just gotten through assets. Let's move on to liabilities. Conveniently enough, the definitions are actually pretty similar to the assets. The definition is found in paragraph 49B of the conceptual framework, and it says, a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Again, there are three key parts. 1. A present obligation. 2. Result of past events. 3. The outflow of economic benefits. A present obligation means right here, right now, you owe somebody something. Usually money. Not that you did owe, not that you will owe. No, I mean that you owe money now. Sure, you might not actually have to pay anybody until some point into the future, but right now, you do owe somebody something. Past events? Well, that's exactly the same as assets. It's pretty easy. And the outflow of economic benefits usually means that you're going to have to pay somebody or do something, or somehow it's going to end up costing you money. So let's say in your business that you make a mistake and you accidentally publish something on your website that's false and it makes somebody in the community look pretty bad. So naturally they decide to call their lawyers and sue you for defamation. But before you go to court, they give you the opportunity to publicly apologize. You can retract the comments and you can correct them with a statement for the public record. In this case, you have the option to actually settle the debt with a sorry, rather than having to pay out money. In which case, it is no longer the outflow of future economic benefits. Thus, there's no liability recorded. Now, next we have the recognition criteria, which is almost exactly the same as assets. The liability has to be reliably measured, and you will probably have to pay for it. Pretty simple. Moving on to equity. Now, equity does not actually have its own independent definition. Instead, it's simply defined as being the residual. Literally, it's assets minus liabilities is equal to equity. Now, for accounting students, this is great because it means you do not need to remember another definition of equity since, well, it's already based on the definitions of assets and liabilities. It's just one less thing to remember. Now you'll note in my depiction here that the black equity is actually less than the assets minus the liabilities. And that's because this year's profit will be included in the equity as retained earnings when we make balance day adjustments. Now, we'll come back to these ideas in a later episode. Moving on to income. Now, both income and expenses are defined by how they affect the net equity of the firm. So, found at paragraph 70A, income is the increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. Okay, that was a bit of a mouthful, but it's not that hard when you think about it in terms of double entry accounting. Let's make it super simple. Income is an event that makes your firm a little bit richer. Expenses are events that make your firm a little bit poorer. So how does the firm get a little bit richer? Either assets can go up or liabilities can go down. Or, in accounting speak, income is a credit, so the other side of the journal has to be a debit. It can't be an expense since this would just net out the income. So it's going to be a debit to either an asset or a liability. Debiting the asset will push it up. Debiting a liability will push it down. The balancing item is simply called income, or the value that has come into the firm. Basically, the firm gets a little bit richer. Notice that if you were buying a new asset, this usually doesn't make the firm richer, at least not right away. If you're buying a brand new computer for your business worth $1,000, you've essentially just swapped $1,000 of cash for $1,000 of computer, but the net equity of the firm hasn't really changed. It really is that simple. And of course, an expense is simply the reverse. Basically, some bad event happens such that it eats away at the overall value of the firm, either by decreasing an asset or increasing a liability. Either way, the journal will have a credit to the balance sheet accounts, and this will result in a debit to the profit and loss report, basically an expense. Now, there is also recognition criteria for both income and expenses, and namely that they be measured reliably. There's no need to worry about the probability here since you're certain that the event has in fact already happened. Definitions! Easy stuff indeed, and you must know them. It's embarrassing when you meet young accountants and they can't remember what an asset really is. I mean, if you met a carpenter and they struggled to explain what a hammer is, you'd be pretty worried. So you must know your stuff. It's that fundamental. Today you learn the definitions of the 5 elements of accounting. These definitions actually include both the definition of the item itself plus a recognition criteria. The most important are the definition of assets and the definitions of liabilities, because the other 3 elements are derived from these first 2, meaning there really isn't that much to remember. And most importantly, you learn that these are really important to commit to memory. My name's Philip Wong. I hope you've enjoyed watching. Happy studies, guys.